Don't think that you have to set like this huge goal and take this step towards this huge goal. You can create a little goal and take a step toward the little goal because the truth is it's the same step.
Welcome to Multifamily Insights. I'm your host, John Casman, and I'm excited for our show today. Listen, before we jump into that, if you are an avid listener of the show, you have to leave us a rating and review because we want to hear from you. Tell us what you love about the show, but also give us some honest feedback. And if you haven't done so, please hit that subscribe button so you don't miss an episode. Today, we've got a great show with a returning guest, Mr. Brian Burke. If you're ready to scale your apartment investing portfolio, but you have questions, make sure you join us live for a special and exclusive Q&A session we're going to be hosting Wednesday, April 24th at 8 p.m. Eastern Standard Time. Now, during this session, we're going to go over some of your top questions and some of the frequently asked questions we receive from both active investors and passive investors. This is a great opportunity to ask those direct questions, get some feedback from us, and learn how to scale your apartment investing portfolio. Join us Wednesday, April 24th at 8 p.m. Eastern Standard Time. Register using the link in our show notes. Again, this is live Q&A session Wednesday, April 24th at 8 p.m. Eastern Standard Time. You can register using the link in our show notes. Hey, Brian, welcome to the show. How are you today?
I'm doing great, John. How about you?
I'm doing excellent. Brian, listen, you are a great guest that we've had on the show before. We will make sure we link to that previous episode in our show notes. But for those folks who don't know who you are, why don't you take 2 minutes to give them a little bit about your background?
Yeah, I've been investing in real estate for 35 years this year. So I started out as a house flipper a long time ago and graduated into multifamily investments a little over 20 years ago, probably about 22 years ago. In my career, I've been fortunate enough to buy about $800 million worth of real estate, which is about 700 single family homes and over 4,000 apartment units. And I've also been involved in lending. I started a lending business about 6 years ago now, and sold that business about 2 years ago. So that was a good move as well. So I've kind of seen the real estate industry from all sides, from the buying and selling side to the operational side to the lending side to the raising capital side. And I think it gives me a little bit of background to have some interesting discussion today.
Yeah, man, listen, you got 35 years experience. I'm not trying to date you, but a lot of experience and a wealth of knowledge, and we're excited to have you on to talk about that. And for me, this is always special because Brian is one of those investors who really helped me open up my mind to apartment investing. And what I mean is, you were the first one to help me visualize and really understand this value add approach to multifamily investing, right? And treating it like almost a flip on steroids as opposed to just buying it based on the existing cash flow and trying to project what that exit cash cap rate was going to be in the future. For those folks who aren't aware, just talk to us a little bit more about kind of your approach. I know you're an author, you've written books, so just give us a little bit more context from there.
Well, I remember the wide-eyed look on your face when you were sitting in the room upstairs in California at a conference we were at, going like, "Oh my God, I just had an epiphany." I'll never forget that moment. So I'm glad that it had some impact on your trajectory. So my approach is always been on the value add side, where I want to buy undervalued or underperforming property, improve it, operate it well, and then eventually sell it. My career took a little bit of a side path about 2 years ago when I saw that I thought we were going to have a market top. So I started aggressively selling everything I owned before the market crashed. And we were pretty successful at that. I sold three-quarters of my portfolio in 2021 and the first half of 22. And then since then, I've been watching the market kind of going into a tailspin, which has been interesting to watch. Glad I'm watching it mostly from the sidelines. We still have about 1,000 units, but it's been an interesting path. So right now, my angle and approach is to do absolutely nothing. I like to say that there's a time to buy, a time to sell, and a time to sit on the beach. I'm getting some time on the beach, some time on the golf course, but I'm getting ready for when that next move is ready to be played, and it's coming.
Yeah, and I want to give a quick little insight and note for our listeners. Whenever you're listening to someone, I think it's really important to understand where they're coming from, right? And recognize that in our conversation here, Brian has done it. He's built that portfolio. You've accumulated the wealth. You've hit a lot of those goals. So you're able to be strategic. Some investors don't have that luxury, right? If you are trying to get out of your W-2 job today, you don't have the luxury to just sit around and wait. So take some of that into consideration throughout the rest of this conversation, right? But Brian, I think one thing that's great is you talked about, you saw kind of where the market was headed. 2021, 22, sold three-quarters of the portfolio. Now you're kind of in this wait and see mode, waiting for the right opportunities to kind of get back and to build up the portfolio. Because you've had so much experience, investing in real estate, you've gone through multiple cycles. What signs or indicators did you look at to realize, you know what, we're probably going to be at the top. Now's a good time to sell. And then when should investors start to look to get back into the market?
Yeah, great question. And just to dovetail onto your comment that you first made in that statement about how not everybody has the luxury to do nothing, right? And we've all been there. I've been there. I remember those days. So if you're in that position right now, don't think that that position is permanent, because we've every one of us that's had success in this business has had a time in their career when they were really struggling to make things work. And that's just part of it. And if you get through that, that's how it breeds your ultimate success. So I'll throw that out there just as a word of encouragement onto what you said there. But things that I'm looking for a lot of it is psychology. Some people will tell you, oh, I look at job growth, or I look at this indicator or that indicator, or I look at, inflation rates or interest rate. I mean, there's all sorts of different economic data points that you can find that you can influence your decision on when to buy and when to sell and all these other things. And not to discount any of those data points, they're all important and they're all inputs, right? But there's another input that I think is enormously important, and that's just overall investor enthusiasm or sentiment. That one to me is probably the most important indicator of a market cycle. And what do I mean by that? So in 2021, we had a property that we had owned for a couple of years, and we had somebody approach us wanting to buy it. And they threw out a number, and it's kind of like you look at yourself and you go, like, if they're going to pay that, then yeah, I think they should have it. If they want it that badly, they should have it. So when that happened, we decided, let's try just to see what happens if we put a property on the market and just see what happens. And lo and behold, after a short marketing period, we have like 20 offers, way over asking price, six-figure non-refundable earnest money deposits day one. And that was reflecting kind of what we were seeing in the competition for when we were trying to buy a property, because we weren't getting anything. And when we aren't, we're asking the brokers like, well, what did the winning offer look like? And they look kind of like this. And you're like, wow, they're nuts. But then when we got offers that where we thought people were nuts, we knew at that point, we're like, if people really want this real estate that badly, I should not be there to deny them. I should let them have it. They can pay me these exorbitant prices. And that's when we went on an aggressive selling campaign. It was just that irrational exuberance and enthusiasm. And then, I look back into like 2009. I went to a family office conference and I gave a presentation on real estate and described why we were transitioning. Well, not really transitioning. We were expanding our buy and flip single family program into a also adding on a buy and hold single family program. We said we're going to buy single family homes in the San Francisco Bay Area. We're going to rent them out. We're going to hold them for 5 years. And our thesis is the price is going to double in 5 years, and then we'll sell them. And I had this guy come up to me after the presentation when I was at my booth, and he's like, you're just flat out wrong. He's like, this is not a time to be buying and holding. Real estate is like catching a falling knife. Prices are still going down. This is a good time to buy and flip. And he went on and on and on about how ridiculous my plan was. But not to be deterred, we went through it anyway. We bought 120 single family homes in the San Francisco Bay Area in 2009, 10, and 11. And 5 years later, we found out we were, in fact, wrong. The prices did not double in 5 years, but in fact, they had doubled and a halved in 5 years. And it was probably one of the best trades we ever made. And my point of this whole thing, this whole story is that when people are aggressively negative on real estate, that is a great time to be buying. And when people are aggressively positive on real estate, it's a great time to be selling. So what I'm looking for now to know when it's time for me to get back in is I'm looking for people to hate real estate's guts. And when all they can say is about how awful it is and capital calls and interest rate cap renewals and foreclosures and can't raise money and all that other stuff, that's going to be a fantastic time to jump in the market with both feet. Now, we may never get all the way there. So we have to be open-minded to, weaker signals, right? But signals that tell the same story. So you kind of get the idea. You've seen the extremes, but there are variations kind of in between.
There's that old Warren Buffett quote, right? To be fearful when others are greedy and greedy when others are fearful. And that's exactly what you're talking about. At
That's
some
exactly
point,
what I'm talking about. That's
yeah,
exactly what I'm talking about. But I want to expand on that comment though, because I hear that comment a lot. Here's the thing. So 6 months ago, people were quoting that and they were saying like, be greedy when others are fearful. People are fearful. It's time to buy. They were saying this 6 months ago, right? I wasn't buying. Well, the difference is there's a key distinction. 6 months ago, and maybe even arguably today, uh, buyers were fearful. Buyers were fearful that interest rates were going to go up. Buyers were fearful that interest rate cap costs were expensive. Buyers were fearful that rent growth was starting to slow, right? But sellers were not fearful. Sellers are like, hey, I'm 95% occupied. I'm hitting my NOI targets. I'm under no duress to sell. I'm not selling at today's price. I'm going to wait this out. And so what we have is we have this non-transactional climate, right? Buyers aren't buying, sellers aren't selling. When you get two people that want to buy and sell together and put them in the same room, they can't agree on a price. So therefore, nothing is trading. To get the Warren Buffett comment to play out the way we want it to play out, what you want to see is you want to see sellers fearful. When sellers are fearful, like, I'm going to lose this property in foreclosure. Sellers are saying my loan is coming due in 6 months and I have no way to refinance. I don't have the capital to lower the principal amount. I'm running out of money. I have a rate cap renewal that's coming up and I don't have the funds for it because I didn't reserve for it. All of those kinds of things. When sellers become fearful, that's when prices move. And we haven't quite gotten there yet, but we might get there soon.
yeah, and I think that's a great distinction, right? When we talk about that fear, it's not just on the buyer side. It's got to be, it needs both parties to be involved there. Talk about kind of the outlook, right? When we talk about, hey, when is it going to be time? There's a lot of reports. I read a TREP report recently that talked about the amount of loans that are at risk of default because they're either, a negative DSCR or,
Starts with a
uh,
T.
yeah. So all those different things. Talk to us about that.
Yeah, it starts with a T. It's trillions. That's the thing. It's like, what is it, $1.5 trillion of potential at-risk debt. Now, not all of that's going to translate into great deals that you're going to go get to sweep up. Some of it will, but that's all you need is some, right? We don't need all real estate to go to default to create an opportunity. We just need some kind of distress, something to make sellers fearful. There's a lot of bridge loans originated in the period of 2020 through 2022 that have 3-year maturities, maybe even arguably 2019 to 2022, that have 3-year maturities that are coming due. And that means that the borrower has to sell the property or refinance. Now, that isn't always a problem. But it's definitely a problem when values are down at the time that event happens. So, I was on a podcast recently where I made the point that, there's a lot of loans coming up for maturity. And, another guest on the show was like, yeah, but, if you take 5-year loans and you add up all the amount of debt that's out there and you divide that by 5, isn't that kind of the amount that's coming due in any year? And that's true. Yes, that is true. But it's not really the amount of debt that's coming due that's the issue. It's the environment in which that debt is coming due. And if that debt is coming due after the market's had a 20% run up, rent growth is out of control upwards, you've got low interest rates, then those maturities aren't a big deal. You go, you refi, you get permanent debt, you sell, whatever, no problem. But when that happens in a down market, when prices have fallen 20%, 25%, maybe 30%, which we are seeing in some markets, by the way, and you've got interest rates that, the expiring loan is was a 3 when it was originated, and now it's a 7 because the rates have gone up, or maybe it's even an 8 or a 9, and refinance rates are high. And that means that the property is coverage constrained, which means that the debt service coverage ratio, i.e., the amount of income versus the payment, isn't there to support the same level of debt. And now you can only get a loan for less, and you have to come up with cash for the difference. That's when these maturities are a problem. And it's happening. There's a lot of loans that originated at what I would call the peak of the market before prices fell 15 or 20%. So we're talking 2020, 2021, early 2022. When those things come due and now all of a sudden the property's worth less, how does the borrower escape this? They can sell, but they probably owe more on the property than it's worth. They can refi, but same problem. They have to come up with money, or they have to have a complete wipeout of the investor's equity. And this is kind of the quandary that people are going to find themselves in. Now, some people are saying, well, that's not going to happen because lenders are extending and all this other stuff. Okay, lenders will extend and pretend, and they might say, all right, we're going to give you another year just so we don't have to foreclose now. But the moment that lender can see that they'll at least get their principal back, all of a sudden their spirit of cooperation goes out the window, and it's foreclosure time, baby. And that's what you got to watch out for.
Yeah, I think it's really important for people to understand what you just said and the reality of it. And it's not a small number of deals or folks who are facing a situation. There are a number of deals that were taken out over the last few years with that exact scenario. And someone may say, yeah, but if I have a value add deal and I'm going to do some renovations, I'm going to be driving the NOI. But if you need a 60%, loan of value on a renovation, but you took out that loan at an 80% loan of value and you assume the cap rate would be a 4 or 5 when you were going to go to refinance, but it's actually a 7. And by the way, your interest rate is no longer a 4, it's actually a 7 as well. You can start to see how this becomes a big issue when you start putting those numbers on paper. You could, in theory, drive the NOI of a deal up by $100,000 and still have less value than when you bought that property. So this is a real issue that a lot of people are facing. It's not just some random hypothetical we're talking about. There are real investors I know, and I'm sure real investors that you know, who are in this exact position today. And right now, maybe they are able to kick the can down the road and get an extension with their loan. But there are a number of folks who are either putting deals on the market or looking to refinance to try to figure out how they can get out of this conundrum.
That's right. And here's a math lesson. So a 4% cap rate and a 6% cap rate. If a 4% cap rate moves to a 6% cap rate, you say, oh, that's not such a big deal. It's only a 2% difference. But that's a 50% haircut in value. Therefore, you would have to double the property's income just to make it worth the same. So when you think about it in those terms, yeah, you're going to value add. Maybe you're going to add 20%, maybe you're going to add 30%. But if you have a 50% haircut or a 50% headwind, you've really not gained any ground. And if you started at an 80% LTV, your property is probably worth what you owe on it. Now, if you started with a 60% LTV, there might be some room in there. And, those are the people who are going to have an easier out from this situation. And, I've been advocating for years on deaf ears. Nobody listens to me, but I've been advocating for years. Don't take out too much debt when you buy, because your debt structure is going to set you up for either success or failure. And that decision is made at the time you take that loan out. If you take out too short of a loan with too high of an LTV, you've already stacked the deck against yourself. And unfortunately, this is kind of part of the problem of being a growing real estate investor, right? When you're first getting started in this business, it's difficult for you to say, well, I'm just going to go get a 65 LTV loan and come up with all this equity to make up the difference of the purchase price because you're struggling to raise capital, right? So it's a challenge, and this is going to affect newer investors who are getting a little over their skis more than it's going to affect seasoned investors who were playing it safer and conservative from the outset.
Yeah, I love that. And I appreciate you sharing that math analogy just to help us understand, it's not just 2%. You're talking about actually a 50% increase. So really good for us to think about it from that standpoint. Brian, where do you see, opportunities as you move forward, both from a market standpoint, and I know you had the lending business, you had other opportunities. Like, where do you see opportunities, even if it's not in multifamily?
Well, I'm still in the debt business, just in a different way. So we started a loan origination company. We originated $2 billion in real estate loans to real estate investors, basically bridge loans for house flippers. When we sold that company, well, actually, when we operated that company, the way that we did it was we would originate the loan using our cash, and then we would immediately sell the loan to one of our institutional partners. So we could originate a lot of loans without a lot of money. And when we sold the company, we realized that, being on the other side of that transaction isn't that bad either. So now I'm on the other side of that transaction. I'm actually buying loans that are secured by real estate. And in fact, I'm buying loans from my old company, quite frankly. Uh, and that's been really good. And that's where I'm finding opportunity right now. And the reason, I mean, it's a different opportunity. And that's part of the thing, right? It's like I'm not shooting for the moon and hoping to get 15, 20% returns. This is not sexy. It's kind of like 8%, maybe 10% on a good day type stuff, but it's safer than shooting for the moon and being an equity investor because somebody else's equity is in first loss position, and I feel very comfortable being in that spot right now. So in other words, if I've got $1 million property and we make a loan for, let's say, 650,000, and the borrower comes up with the other 350,000, they have to lose 350,000 before I lose a dollar. And when you're playing defense, that's a really good spot to be. And right now we're playing defense, and we're not shooting for those high returns. We're shooting for more safety. And eventually that will change, and we'll be back in the hunt looking for buying opportunities in real estate where we'll be that $1 on the dollar, not the 65 cents on the dollar. Hopefully, but buying at a lower basis.
Let's talk to that operator, that newer investor starting out and trying to figure out how to make it work in today's environment. What kind of feedback or direction would you give someone who's starting out today?
I think that anybody starting out today has a huge advantage over anybody that started out earlier. So a lot of people who started in 2019 through 2022 are going to have difficulty, most likely. A lot of them are going to have difficulty and they're going to have impairments on their track record, as a result of lending problems and so on. So somebody coming in fresh doesn't have like what we call legacy issues. They don't have messes to clean up. They can just focus on the positives and on the upside. So in that respect, they have a bit of an advantage. You also have a new investor just getting started has an advantage in that while things are not the best time to buy right now, and there's not a lot to buy anyway, if things are a little slower, you have a little bit more time. You can build your business, you can build your systems, you can build your contact list, you can build your investor base. Because when things are really going and there's a lot of transaction volume and that kind of stuff, you're going to be running 100 miles an hour with your hair on fire. You're going to be too busy to build much of anything. You're just going to be in the thick of it. And then you're going to go like, man, I didn't get to build my list, or I didn't get to refine my systems, or, I was operating completely inefficiently because I didn't have the tools that I needed. I didn't develop the tools that I needed. So do that. And then the other thing is, let's say you get to that point and you've built all of those things, and now you actually want to start buying real estate. My advice would be to buy small. And I know people used to like to say, oh, I won't get out of bed for less than 100 units, or, or I want to be big. I want to buy $10 million properties because that's, big profits. Real estate is not an overnight road to riches, and for anybody that thinks that it is because they've seen that happen to somebody, for every person that has gotten rich quickly in real estate, I can show you someone who lost it all quickly in real estate. So just treat this game as a long game. Know that it takes a long time for all this stuff to really produce the result you're looking for. Be okay with starting small because right now that's really where the opportunity is. There's no real opportunity buying 100-unit apartment buildings right now. Go buy a duplex, go buy a fourplex, go buy a single family home, because in that world, there are owners out there who are strapped, who are tired, who are retiring, aging old, done with the business, hate it, inherited property from a relative, and they don't know what to do with it. In that world, there are unique needle in haystack style opportunities. In the 100-unit and up space, those owners are sophisticated, they're capitalized, they're connected. It's in a way a bit more of an efficient market, and you don't get those kind of one-off needle in haystack opportunities. So go searching for those, because you can find some of that stuff even in a bad market and get a really good deal on it, and it'll pay off for you.
I think that's excellent advice, Brian, and it gives you a chance to learn and grow and recover and, start to build some wins. And you don't need to raise as much money on a deal like that if you are raising capital, right? So it gives you a chance to really grow and scale your business as opposed to, shooting for these 100, 200 unit deals where it's very complex, it's very competitive. You're competing with groups who have been sitting on the sidelines and looking for opportunities for a while. They're probably not looking to buy that 10, 15, 20 units. So it gives you a great opportunity to kind of get in and get started. Brian, you're also the author of The Hands-Off Investor. Talk to me a little bit more about this book.
Yeah, this book was written out of a desire to help passive investors invest in real estate syndications. And there's books all over the place. I could wallpaper my whole house with books on how to get rich in real estate and how to buy real estate, how to operate real estate, how to repair real estate, fix it up, sell it, broker it, all those different things. But there really wasn't a book out there that would show someone that had money to invest in a passive real estate offering and didn't want to do all the work, but how to do that properly and not just go out and just start throwing money around at people, without doing any kind of due diligence. So this book teaches the world of passive investing, what that looks like, how to do it, how to vet sponsors, how to vet opportunities, how to determine whether those offerings are compatible with your investing goals, and just all that sort of thing. So it's for if you like to invest in real estate using OPM, which is other people's money, what if you're the other people? And you're on the other side of that transaction. How do you educate yourself on your role? And that's what this book does.
No, I love it. We'll make sure we link to that in the show notes as well. I think it's a great read. And one of the things that, stood out to me was just that it's a book for both operators and passive investors. I know you wrote it with the passive investor in mind, but I think even as an operator, it gives you a sense of, what to be looking for, what to pay attention to, how to make sure you're presenting yourself, your deals, your opportunities in the right light, and also make sure you're asking the right questions of your own deals. So, you're taking the right look at it and you are, operating in a very sophisticated manner as opposed to maybe, putting something together, put in front of a potential investor without maybe thinking through some of those key details. So I think it's a really great read for both the active investor and the passive investor, even though it's written with the passive investor's edge on there.
It is. And imagine yourself as being a student in a class. And at the beginning of the class, the instructor said, here's all the test questions and all the answers. Wouldn't you want to have that document when you got started in the class? Well, this is kind of the same thing. If you're an active operator, you're a syndicator, you're going to be raising money from people. Wouldn't you think it would help you if you had all the questions that those investors are going to ask you and what the answers are? Because your investors are going to be the proctor of your final exam, and they're going to determine whether you pass or fail. So give yourself an advantage.
I love it. I love it. We'll make sure we link to all that in our show notes. And again, if you want to learn more from Brian, his company, and check out his book, you can go to praxcap.com. That's praxcap.com. And we'll make sure we link to that as well. Brian, we're going to go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Brian, give me a failure or an apparent failure that sets you up for later success.
It was in the last market downturn, 2008. I bought a 60-unit apartment complex, and it was a value add deal. It was a foreclosure. I bought it for half of what the previous owner paid, and I thought that was a great deal. What I didn't recognize was that the market or the economy was going to collapse 6 months later. So right in the middle of my value add plan, as I got the place to 99% occupied, all of a sudden the next shoe started dropping and the economy went straight into the toilet. Next thing I knew, the property 65% occupied. The property was 100% financed because the foreclosing lender was like, if you'll just take it, we'll finance the whole thing from you. That should have been warning sign number 1. But nevertheless, I got to this place where the property wasn't producing enough income to do anything other than pay the expenses. No money left for debt service. And I had to make a choice. Do I hand the keys to the lender? Do I let them foreclose? Do I tell my investors they've been completely wiped out? Or do I reach into my own pocket and start paying the mortgage payment out of my own pocket? It was $15,000 a month. And so that's the choice I made. I said, I'm gonna do that. Thank God I was making good money off of our house flipping business at the time, and I had the resources to be able to pull this off. But I did, and it was lots of uncomfortable conversations at the dinner table over, why are we taking all of our hard-earned money and throwing it into this loser deal? And I kept saying, to myself and to my wife, I'm like, I have to get through this period without missing a single payment and without losing any of my investors' money, because in the future, that's going to be very important. And as it turns out, it was enormously important, because I wouldn't be where I am today if that deal hadn't happened, because of 2 things. Number 1, I saved the deal. I never missed a payment. My investors ended up getting all their money back, plus a profit when we finally sold. And I learned some incredible lessons about over leverage, about the power of economic fluctuations, about occupancy and vacancy, and all those different things. And that terrible experience set me up for all the success that came to follow. And I wouldn't have been able to capitalize on that future success had I not had that experience.
Give me a digital or mobile resource you recommend for your business.
I think one of the better ones are things like Google Maps. What an incredible invention that is. And just to be able to drive around the neighborhood using Google Street View and Google Maps to kind of check out an area that you're not familiar with. I like data sources like CoStar and Axiometrics to give myself information on rent growth, past and future forecasted rent growth, occupancy rates in various markets. I like the Census Bureau's website and mostly their news releases. Their data is so hard to figure out, but their news releases are really helpful when you can see, like, here's the places where you have the most population movement going to, here's the places where you have the most population movement coming from. Figuring that out and investing in markets where people are moving to and avoiding markets where people are moving from is really big in the area of income producing real estate, and that resource is enormously helpful.
Besides your own, give me the book you've recommended or gifted the most in the last year.
Oh my gosh, I never recommend any books because I never read any, so I have to go back further than a year. I mean, everybody's read Rich Dad Poor Dad. It's probably one of the best mindset books that's ever written, so I really like that. I also like this book on, it's called TED Talk or TED or so TED Talks. It's written by the guy that does TED Talks, and it talks about it teaches you how do you give a presentation and deliver information in a way that's motivating and helpful for people. And in this business where we're raising money, you can't raise any money if you can't convey your thoughts and ideas. And that book's been really helpful for that.
I'm actually listening to that one on Audible right now, so that's a great read or great recommendation there. All right, give me a daily habit that helps you stay focused on your goals.
Every day I get up and I get after it. I don't like laze around and wait. It's like I get into my office and I start up my day and work towards whatever my goal is. And you just have to take one step. I mean, it was 25 years ago, I think, when I finally said to myself, all I want to do is buy one house a year. If I can buy one house a year, by the time I'm ready to retire, I'm going to be so far ahead of, most of the population. And that little goal is really what set me on the path to get me where I am now. So, don't think that you have to set like this huge goal and take this step towards this huge goal. You can create a little goal and take a step toward the little goal, because the truth is it's the same step.
Give me your number one insight for understanding market cycles.
Human psychology. It's all about market sentiment and knowing when people are too excited or just too what do you say, too pissed off at the market. And not to be just real estate. I remember back at the dot-com bubble of 2000 stock market, everybody was buying stocks. Dot-com stocks was the thing in 2000, and all of a sudden it came crashing to a halt. Because when when people that know nothing about it are like exuberant and flooding in, something's about to go wrong. And that tells you that the market cycle is about to shift.
All right, you are out there. I think you're in the Bay Area, right? Are you still in Northern
Yeah,
California?
Northern
All
Cal.
right. Give me your favorite place to grab a bite to eat.
Nowhere here. My favorite place to grab a bite to eat is in Maui, because I live there a quarter of the year. So my favorite place to go, well, it used to be Lahaina Grill, but it burned down along with the rest of the town. So now I would have to say Leilani's on the beach is probably one of my top favorites.
All right, we'll definitely put that in the show notes there. Sounds like a great place. Brian, always a pleasure talking to you. You gave us a little bit on your background, 35 years of experience doing all sorts of different, asset class investments and really understanding where we're at in this current cycle. I loved how you talked about the psychology of investors and recognizing that, when people get really upset about the market and almost have a disdain for it, that is the time you want to be an investor. When everybody's excited and everybody feels like they can make money, probably a great time to be a seller. So just understanding the investor psychology. We talked a little bit about your book, The Hands-Off Investor, and all the great information we can gain, both being an active investor or being a passive investor. So we'll definitely make sure we link to that in our show notes. Again, Brian, always a pleasure talking to you. We look forward to staying in touch with you and I hope you have a great day.
Thanks, John.